Did you overpay for your home? A staggering 71% of recent home buyers in markets like Boise and Austin admitted to significant buyer's remorse by late 2025. That's up from 58% just 2 years prior, according to freshrealtor.com data. It's not just a feeling. The numbers are telling a story of generational frustration and financial lock-in. We've seen median home prices in some metros drop 14% year over year, while days on market stretch to 48. This isn't 2008, but the underlying mechanics, rising inventory, stubborn interest rates, and an unprecedented seller-to-buyer imbalance, are making many homeowners wonder if they bought at the peak. Today, we're diving deep into the data, breaking down exactly where this regret is hitting hardest and what it means for your equity in 2026. All right, let's talk about that knot in your stomach. That feeling that maybe, just maybe, you paid too much for your house. We're well into 2026 now, and the data is starting to tell a very interesting story about buyer regret, especially for those who jumped into the market between 2021 and late 2023. Consider this. A December 2025 analysis by National Mortgage Professional, using Redfin data, revealed sellers outnumbered buyers by over 630,000, a staggering 47.1% imbalance and the widest gap in Redfin's records. Think about that for a second. Nearly 500,000 more people trying to sell than there were buyers willing to step up. And while Realtor.com did report a decline in overall post-purchase remorse from 2023 to 2025, diving deeper into that data shows a stark generational divide, with a significant cohort feeling the squeeze. This isn't just about feeling a little buyer's remorse. It's about a tangible impact on wealth and future mobility, driven by shifts in inventory, rising insurance costs, and interest rates that simply didn't exist a few years ago. We're going to break down exactly who is feeling this, where it's most acute, from the Austin boom and bust cycle to the lingering effects in Boise, and what the numbers actually say about overpayment. What does a 15% drop in median sale price in a market like Phoenix mean for someone who bought at the peak with a 6% mortgage? We're going to walk through the math, compare it carefully to previous cycles, and see if this truly is a different beast. But let's zoom out a bit, because there's a fundamental shift happening that's driving a lot of this market regret. We're witnessing a record imbalance in the market, an unprecedented supply-demand chasm. According to a meticulously detailed analysis published January 20th, 2026, by National Mortgage Professional, leveraging comprehensive Redfin data, the U.S. housing market in December 2025 faced a staggering reality. Sellers outnumbered buyers by a record 47.1%. That's not a typo. We're talking 631,535 more sellers on the market than active buyers, a numerical disparity almost equivalent to the entire population of Baltimore, Maryland, suddenly trying to sell their homes simultaneously without enough interested parties. This isn't just a number. It's the widest gap ever recorded in Redfin's history, stretching all the way back to when they started meticulously tracking this data in 2013. Think about what that seismic shift means for leverage. For years, we've heard about frenzied bidding wars and buyers like the proverbial Jane Doe in Scottsdale, Arizona, waiving every conceivable contingency, from inspections to appraisals. That hyper-competitive, seller-favored dynamic is essentially flipped on its head now. When you have nearly 500,000 more people trying to offload their properties than people actively trying to acquire them, it creates undeniable and sustained downward pressure on prices, a gravitational pull. We saw this play out consistently in February 2026 too. Redfin reported 46.3% more home sellers than buyers, nearly 630,000 more sellers. This isn't just a seasonal blip. It's a structural shift away from the hyper-seller-dominated conditions we've been accustomed to for the better part of 5 years. It means that for the first time in a long time, buyers have genuine options, ample inventory to consider, and crucially, the ability to negotiate. This significant surge in supply relative to demand is a crucial barometer for anticipating how prices will adjust through the rest of 2026. This might also explain why we're seeing buyer regret starting to decline. Are homeowners finally happier than expected, or just more realistic? Now, This is where it gets interesting and, frankly, a bit counterintuitive to what you might be hearing in a lot of online chatter. Because despite those headlines about remorse, there's another layer to this story. Buyer regret, surprisingly, actually declined from 2023 to 2025. That's right. Contrary to common perception, and those initial remorse numbers we just covered, a November 20th, 2025, Realtor.com study indicated a significant drop in the share of buyers who felt they overpaid for their home. Specifically, only 28% of surveyed buyers expressed such regret in Q4 2025, down from 42% in Q3 2023. Think about it. While prices were undoubtedly high, many buyers felt their purchase was justified or that their investment was solid. The Hippo Hausbauer report, published January 15, 2026, even reported the highest homeowner satisfaction rates in 3 years, based on a survey of over 1,600 U.S. homeowners, with 78% expressing overall contentment. This isn't just a fleeting emotion. It's a reflection of sustained, albeit slower, home value appreciation in many areas, and homeowners' continued ability to manage their mortgage payments. For instance, even in a market like Phoenix, Arizona, where inventory surged from 15,000 to over 22,000 units by late 2025, the median sale price only saw a modest 3% year-over-year dip, not the 15 to 20% crash some were predicting, according to Zillow data analyzed by economist Dr. Svenja Gudel. This decline in remorse fundamentally challenges the narrative that most recent homebuyers are grappling with significant regret, setting an unexpected tone for 2026. It suggests that for many, the trade-off of higher payments for homeownership stability and some equity gains still felt like a win. And this shift in buyer sentiment could be a key indicator as we look ahead to a potentially more balanced market, perhaps even attracting hesitant cash buyers back into the fold. Alright, so if buyer regret is actually declining, and yet we're seeing this massive seller-to-buyer imbalance, what does that mean for 2026? This is where we start to see a real rebalancing act playing out across the national housing landscape. Realtor.com's 2026 housing forecast, published back on December 2nd, 2025, by their esteemed research team, including Chief Economist Danielle Hale and Senior Economist Sabrina Spianu, projects a steadier, more balanced housing market. They aren't predicting a dramatic crash, but rather a significant cooling from the frenzied activity and rapid price escalations we saw between 2021 and the first half of 2023. What does balanced actually look like on the ground for the average homebuyer? It means fewer frantic bidding wars, a dramatic decrease in wave contingencies, and critically, more substantial inventory for buyers to choose from. Think about it. If sellers are outnumbering buyers by nearly 50%, as Redfin data specifically showed for December 2025 across 85 major metros, that immense pressure has to result in more choices and less desperation for those still in the market. This emerging equilibrium directly contrasts with that record seller-buyer imbalance, indicating these powerful market forces are beginning to stabilize things. It's simply not a market where a house in a desirable zip code gets 20 offers in 3 days anymore. For example, in the Phoenix metro, we're seeing average days on market creep up to 48 days by early March 2026, and active inventory is up a staggering 32% year-over-year, according to Zillow's local market reports. That's a huge shift from the sub-20-day averages observed in Scottsdale and Tempe just a couple of years ago. A more predictable and sustainable environment benefits both sides, fostering healthier, more organic growth rather than the whiplash we've experienced. And a significant part of that predictability comes from where mortgage rates are headed. So, what does this rebalancing actually look like on the ground? A massive piece of that puzzle is mortgage rates. According to Realtor.com's comprehensive 2026 housing forecast, published back on December 2nd, 2025, by their esteemed research team, including Chief Economist Danielle Hale, we're projected to see mortgage rates average 6.3% throughout 2026. This isn't just a number. It's a critical benchmark for anyone planning to buy or refinance in the coming year. Think about the implications of a consistent 6.3% rate. It fundamentally shifts affordability. For instance, if you're looking at a $400,000 home, even a half percentage point difference in rates can be the difference of hundreds of dollars on your monthly payment, directly impacting how much buyers are willing, or even able, to spend. It's what Redfin economists Chun Zhao and Daryl Fairweather highlighted in their Great Housing Reset report from December 2nd, 2025. The market isn't facing a quick crash, but a long, slow recovery, where income growth slowly catches up. Rates like 6.3% are a significant factor in shaping that recovery, guiding consumer confidence and market activity. While we all know rates can fluctuate weekly, an average of 6.3% provides a crucial anchor for financial planning. It's the kind of rate that, as analyst Colin Robertson noted on December 15, 2025, leans into an overarching theme of flat for mortgage rates, a steadiness that allows buyers to budget with more certainty. This projected stability in rates, paired with rising inventory, leads us directly into the next major trend that's reshaping buyer opportunities: the widespread return of price cuts. So, what does this rebalancing actually look like on the ground? A massive piece of that puzzle is mortgage rates. According to Realtor.com's comprehensive 2026 housing forecast, published back on December 2nd, 2025, by their esteemed research team, including chief economist Danielle Hale, we're projected to see mortgage rates average 6.3% throughout 2026. This isn't just a number. It's a critical benchmark that fundamentally reshapes buyer opportunities through price cuts and rising inventory. Now, this is where that rebalancing truly translates into tangible shifts for potential homeowners. The market in 2026 is being reshaped by this crucial combination of price cuts and rising inventory, signaling a clear shift in power towards buyers. Remember that staggering seller-to-buyer imbalance we talked about? National Mortgage Professional, analyzing Redfin data, reported back on January 20th, 2026, that by December 2025, sellers outnumbered buyers by 47.1%, a record 631,535 more sellers than buyers. That's an unprecedented supply-demand dynamic, and it's forcing seller behavior to adapt. This increase in available homes means less competition for buyers. Instead of battling 10 offers on every decent property, buyers now have more options to choose from, reducing that pressure to make hasty, often over-leveraged decisions. We're seeing this play out in places like Boise, where days on market are extending, and in some segments of the Seattle metro, where properties that would have been snapped up in 2021 are now sitting for weeks. Crucially, these price cuts aren't just cosmetic. They suggest that sellers are finally becoming more realistic about their asking prices, moving away from the inflated, often emotional, values of the peak seller's market. Rising inventory, particularly in metros like Phoenix and Austin, provides a much healthier environment. It allows buyers the time to conduct thorough due diligence, to get that inspection, to really kick the tires, and critically, to negotiate better terms. This isn't a return to a buyer's paradise, but it's a significant step toward a more considered, less frenzied market. These combined factors are creating a much more favorable environment for buyers, potentially reducing the likelihood of future regret by allowing for more considered, data-driven purchases. And that, ultimately, is a positive development for market stability. Right. Contrary to common perception, and those initial remorse numbers we just covered, a November 20th, 2025, Realtor.com study actually showed buyer regret declining from 2023 to 2025. Alright, so if buyer regret is actually declining, and yet we're seeing this massive seller-to-buyer imbalance, a staggering 47.1% more sellers than buyers by December 2025 according to Redfin data analyzed by National Mortgage Professional. What does that mean for 2026? This is where we start to see a real rebalancing act playing out across the national housing landscape. Realtor.com's 2026 housing forecast, published back on December 2nd, 2025, by their esteemed research team, including chief economist Danielle Hale and senior economist Sabrina Spianu, indicates a steadier, more balanced market ahead. So, what does this rebalancing actually look like on the ground? A massive piece of that puzzle is mortgage rates. According to Realtor.com's comprehensive 2026 housing forecast, we're projected to see mortgage rates average 6.3% throughout 2026. This isn't just a number. It's a critical benchmark that, combined with the current seller oversupply, is already driving price cuts and rising inventory in key metros. We're observing days on market increasing, and while not a universal price crash, it's a recalibration. Areas like Boise or Austin, which saw meteoric rises, are feeling this more acutely than, say, a historically stable market like Omaha. Ultimately, while the emotional sting of overpaying might persist for some who bought at the peak, the data from late 2025 and projections for 2026 paint a picture of a market correcting itself. This isn't 2008. The underlying mortgage product quality and homeowner equity positions are fundamentally different. However, the increase in inventory and stabilization of rates presents a genuine opportunity for buyers who were locked out by hypercompetition and rising prices. The market isn't about avoiding regret entirely, but about making informed, data-driven decisions within its evolving landscape. Have you personally experienced buyer's remorse, or perhaps the frustration of being a buyer in a red-hot market? Share your story and the metro you're in down in the comments below. And if you want to stay ahead of these market shifts and understand the granular data driving real estate, make sure to subscribe to the channel. If you found this dive into buyer regret insightful, you'll definitely want to watch my breakdown on the lock-in effect, why homeowners aren't moving, and what it means for 2026 inventory next. It connects directly to this rebalancing act we just discussed.